Hi everyone, it's your daily 10-minute business and finance news wrap for this Wednesday, the 1st of December 2021. Later property prices up 22% over the past year. That's according to Corelogic here in Australia. But first, let's go to the Australian economy, where GDP contracted less than expected in the September quarter by 1.9%. Still, that is the third largest decline on record. For the year, the economy expanded 3.9%. So to make sense of all of this, I spoke earlier with Katrina L. She's the senior economist at Moody's Analytics. It showed that those states that were not in lockdown, particularly Queensland, did quite well, didn't it?
Yeah, and that's a really good point. And that's really a symptom of the fact that the economic recovery prior to the Delta outbreak in those several states was actually quite strong. And so the fact that we did see decent growth coming from Queensland, South Australia, even Western Australia, goes to show the underlying strength of the economic recovery in Australia. And we are expecting that has resumed in the fourth quarter now that the movement controls have eased in the other states.
Can we go into more detail about the actual numbers today? Where exactly do you think the surprise came from, and why the better than expected result?
Yeah, that's a really good question. I think it really comes down to there was a high level of uncertainty about how bad the numbers would be. I mean, economists knew that it would be a decent contraction, but we just didn't know how much of a contraction because, only half the economy was in lockdown. So we weren't really sure of how much underlying strength there really was in the economy outside of those states that were subject to the lockdown. And what it does go to show is that underlying strength. And so that's a really good thing at the end of the day, that the economy was able to not experience as deep a contraction as what was expected in some circles.
What about that household savings ratio at nearly 20%, close to that peak we saw earlier last year, right? How does that bode for the economy going forward? And what does it say about, consumer spending, purchasing power in the future?
Yeah, so one thing I would note with that jump in the household saving rate in the third quarter is, GDP is notoriously backward looking. So it's not surprising that household saving jumped in the third quarter just because half of households in Australia were forced to stay home. So beyond spending on goods and getting more groceries delivered or, fixing up their home office, there wasn't much they could do, so they were forced to save. Whereas now that, the movement controls have been largely wound back in those states, we're seeing already service spending is really picking up. And so, there's still quite a lot of pent-up demand. Now we've got domestic and international borders reopening. So we should start to see that saving rate start to trend lower heading into 2022, just as households, businesses are able to really get out there more and resume more of that normal economic activity.
So where to now for GDP? How strong do you think the current bounce back will be?
We are expecting a strong bounce back. So we would expect that December quarter is quite strong, given the fact that movement controls have actually eased much more quickly than what was anticipated, thanks to the national vaccination campaign gaining a much more traction than what was expected. So we've got, really good coverage of the population. Vaccine hesitancy has been wound straight back. So we would expect that, that high level of immunity will remain in the community. And as a result of that, there won't be the need to return to harsh lockdowns or harsh movement controls again. And so given that, we should see, a really sustained improvement in domestic demand, specifically household consumption heading into 2022. So we're looking at about a 4% expansion for GDP next year, which is about on par with what we're expecting for this year.
There's one word we haven't mentioned that everyone's saying at the moment, right? Omicron. So let's throw that into the mix. What does it mean for the economy, growth, and any potential change in monetary policy or inflationary expectations?
Mm-hmm. So Omicron has really thrown a spanner into the works, and we don't know a lot about the the issues around Omicron that it's going to bring in terms of, whether vaccine efficacy is going to be high and that kind of thing. So given the high level of uncertainty, what we're saying at the moment is that it really does increase the downside risks to the near-term outlook, not just for Australia, but also globally, because this is, of course, a global issue. And so in terms of policy implications, we're sticking to our expectations that we're not going to see the Reserve Bank of Australia hike rates until mid-2023. So that's quite some it's quite some time away. And, but if Omicron does turn out to be a much more damaging variant, then that does, increase the risk that we would see increased government spending here and abroad to kind of cushion that blow if we do need to go down to more aggressive movement controls. But that, of course, is not our baseline expectations. It's only a downside risk at this stage.
Katrina L there from Moody's Analytics. And of course, the variant is having an impact on the Australian share market, down 0.3% on the ASX 200, 7,235. But there was another variable, and that's the US Federal Reserve. For more on that, I spoke earlier with Chris Weston from Pepperstone. Chris, Omicron. The Fed drops the word transitory when describing inflation. So there's a lot to dissect there. So first, maybe let's start with that new COVID variant. Moderna's CEO overnight made some comments and global investors didn't like it. How's the market feeling about it?
Well, there's so many cross currents, as you rightly point out, with the data that's going to come out in the next couple of weeks ahead of the Fed meeting. What did the Fed do in terms of accelerating its taper program? Like, we're trying to price risk. That's the issue. That's what we do as investors. That's what we do as traders. We try and price risk. And it's just incredibly difficult to do so in this current environment. We've got to make this a set of assumptions that the vaccine that we have at the moment, that we've been, a lot of amount of us has received, will hold up against the Omicron strain. So that's a huge assumption to make. I think the calls from the Moderna CEO have muddied the water a little bit about that, and that coming at the same time as we think that the Fed will, accelerate its QE tapering of its QE program, potentially raise rates from as early as mid next year. It makes life very difficult to price risk, and I think that uncertainty has effectively caused some high volatility.
The US inflation looking like it's a bit more entrenched. That's potentially what the US Fed Reserve Chairman's saying. Is that how you're feeling?
Yeah, absolutely. I mean, I think the market, both myself and the collective thoughts in the market have had that inflation is not going to fall back. I mean, the rate of change on a year-on-year basis may peter out effectively, but inflation prices are going to be high, not just in the US, but on a global basis, and they're not going to roll over too much. So, look, I'm glad that the Federal Reserve, or at least the core of the Federal Reserve, largely share what the market's thinking. I think that kind of validates the position we have. And I think unless we were to see, the current situation in the virus and the Omicron, really sort of hit consumer sentiment and business sentiment, then the Federal Reserve have to accelerate its QE, the tapering of its QE program. It simply has to do so. And I think, they need to start acknowledging that rates will need to go up at some stage next year. And I think obviously that may be positive for the US dollar and may impede on stock market returns. But that's the world we live in now. And I think the Fed need to acknowledge that.
So putting all of that together, right, what does it mean for both the oil and currency markets?
Well, oil is more sort of driven on the demand side at the moment because of concerns about restrictions, lockdown or potential lockdowns, not just in Europe, but in other countries as well. And I think that's hitting the demand equation at a time when the Biden administration have released oil from the strategic petroleum reserves, as have other countries as well. And that's caused oil to move down quite sharply. But the hands are in OPEC this week. On Thursday, we've got the decision there, and they'll put their planned output increases on hold, in my opinion, which should stabilize prices to a degree. But I think oil is so volatile at the moment, and that's one that everyone needs to keep an eye on, because it is obviously so important, as is gasoline and that gas, for the inflation story going forward. So I think that as part of the play that we've been seeing is generally right at the epicenter of markets. It's a fantastic tactical story going ahead into Thursday, and I think the FX markets are sort of following that as well.
And finally, what does this all mean for the Australian share market right now?
Well, we've come off the lows. At one stage we were down 1%, but as I say, there's been this sort of resurgence. Whether it can last is another thing. I think we're in a trader's market. I think we can chop around with high volatility, but the fact is we were down 1% and we've come off those lows, but we're still negative for the day. But certainly I think we've been dragged higher by what we're seeing in China and Hong Kong, and to an extent Japan, and that's pushed up US futures. I think we're sort of going along for the ride. We're still lower, but it could have been a lot worse.
Chris Weston there from Pepperstone. From the markets, let's go to the Australian housing market, where property prices continue to climb, up by 1.3% in November. Year on year, the median price is up 22.2%. So that means an additional $126,000 to the average home over the past 12 months. Property prices in Brisbane rose the most in November, up by 2.9%, followed by Adelaide 2.5%. Our major markets, Sydney rose by 0.9%, so an easing of growth there. Melbourne up by 0.6%. What we're also seeing, according to Corelogic, is that while national capital city price growth is easing, regional areas are climbing. So for more, Rena Sarumpaet spoke earlier with Corelogic's Head of Australian Research, Eliza Owen.
I think what's most surprising for me this month is that while we've seen a slowing of growth across the capital cities, the monthly increase in the regions was 2.2%, which is not only twice the monthly rate of capital growth we saw in the capital cities, it's increasing. The monthly rate of growth is getting higher across the regions. So this could reflect a flurry of activity as lockdowns are eased and more people are free to look for properties in regional Australia. But I think we've not really seen this kind of clear divergence in property price performance across the regions and capitals before. And it's really interesting to observe how the structural changes around COVID are creating that distinct divergence between the markets.
Do we know how much of this is new housing construction and much is just houses and properties changing hands?
So there's definitely signs that demand for both established and new property are very strong. Obviously, with the introduction of programs like Home Builder earlier in the cycle, and even more recently with the increase in the first homeowner grant for Tasmanians, for example, which is directed toward new homes, we've seen a massive uplift in detached house approvals and the amount of construction that's in the pipeline now too. But there's also been a lot of demand for the established market, and overall dwelling values across Australia are sitting 22% higher over the year.
As the kind of supply-demand equation shifts, is that likely to be another factor pushing down house prices or slowing growth?
Yeah, supply is definitely one of the headwinds that we see slowing growth rates and pushing them into declines in a few years' time. There's a few accumulating headwinds for the property market, which include higher levels of construction, more listings coming to the market as vendors try and take advantage of the market moving just past its peak, as well as things like higher interest rates, tighter lending conditions, and also just the affordability constraints that we've seen across the country as well, particularly in our largest cities.
Just focusing on construction, to what extent is the construction that's already happening a factor in slowing the growth in house prices?
Well, I think we've seen the significant uplift in the approvals and dwellings under construction. It's probably going to take a while for those to actually hit the market and take some pressure off both the rental and established market, especially because there are constraints on labour and materials that are extending that piece of construction work. In some ways, it's a good thing because it means we have plenty of construction work to sustain us into 2022 as well. But in the meantime, it does mean there is some pressure kept on the housing market.
Do you think it'll be a significant factor?
No, I think the more significant factor will probably be mortgage rates and how that is influenced by the cash rate. I think that the record low mortgage rates we've seen through the current cycle have been a major contributor to price growth, and it makes sense that that relationship would work the other way. So when the interest rates start to go up, that's when we expect to see a turn in housing market conditions.
So November's results that we have released today, what do they tell us about the economy as it is at the moment, more broadly?
Well, the continuation of house price increases has had multiple benefits for the economy in terms of the COVID recovery. It has increased wealth effects for people who own property. It has increased turnover with over 600,000 property sales taking place over the past 12 months, remembering that for the decade average, it's been closer to 460,000 sales. But it does create some areas of weakness in the economy, particularly when we're talking about wealth equality, people who aren't in the market and aren't able to keep up with those price increases tend to find it harder to ever access the housing market. So I think for the short term, this housing upswing has been very important for the economic recovery from COVID, but in the longer term, it does create greater inequality, and there are structural issues associated with that as well.
Eliza Owen there from Corelogic speaking with Rena Sarumpaet. This On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It's not personal advice and it doesn't consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.